Jeff, welcome back. Good to see you.
Good morning. It's hard to follow the bite my butt segment.
That's right. We'll try. You've made the point, and you've been articulate about it, that there's a level at which long duration names get cheap enough, or people stop making fun of them.
Well, as you guys know, I'm a homer for long duration. For us, that's software companies in particular and cloud names that have a very long opportunity to go after giant markets. And I think what you've seen over the last few weeks, you saw, some of the what we would call blue chip companies like Snowflake bounced up 38% from its bottom, CrowdStrike up 37% from its bottom. I'm not a market timer. I can't really tell you what the rest of the year looks like. We could have a recession, as has been well documented. But it certainly feels like investors have seen a little bit of a floor around these names. And then you have very smart folks like Thoma Bravo coming in and buying a great software company like Anaplan at over 13 times forward revenue. And I think that was a strong signal to the market that there is a floor where folks will come in and buy these companies if they get too cheap.
Do you think that like, for example, I'm thinking of a call today out of the sell side about Dell and HPQ. I mean, they worry about consumer, but they also worry about IT hardware budgets over the long term because of the uncertainties you mentioned. I mean, how do you process those? It's not an irrelevant concern, right?
No, and I would be worried about IT hardware as well. I mean, the world is moving to software and moving to cloud. So I think, you had Dave McJanet from HashiCorp on yesterday. We're a large shareholder in HashiCorp and big believers in what they're trying to do. If you think about the movement to the cloud that large Fortune 1000 companies are making, these are 5 to 10 year moves. These are multi-year budgets that get set in place, and rarely are they pulled back because they're transforming their entire business around the world. Firms like Accenture, Deloitte, Price Waterhouse have literally been hiring thousands of people every month to meet the demand of large enterprises that are buying this technology and deploying it. And I think that's why you see investors really viewing these as safe bets over the next 5 to 10 years, while we see market volatility that's really hard to forecast in other sectors like consumer, as you point out.
Jeff, good morning. It's Deirdre. I wanted to ask you about the latest proposed SPAC regulations from the SEC. It would essentially force SPACs to meet similar standards as traditional IPOs. And I wonder, do you think that this is good or bad for the retail investor? I mean, projections in the majority of SPACs we know have fallen short, but it's also a way for the average investor to get into some of the companies that you get into at a much earlier stage, that is.
Yeah, I've been pretty clear on Twitter in general, not a huge fan of the SPAC movement. I think it brought a lot of companies public that should not have been public. They weren't quite ready to be public. Having said that, the top 10, 15% of SPACs, there are some that have done very well, terrific companies that could have done a traditional IPO. I think the forecasting issue is one that you've highlighted many times and is an important one. When a company goes through a traditional IPO, they can't really give a forward-looking forecast. They work with analysts to kind of set expectations a little bit, but for the most part, they're not able to do the forecast that the SPAC companies were able to do. So I think it's a little bit of a gray area or a loophole, and hopefully the SEC will close that and we'll have a more efficient process. We're all for more companies being public. We think that's a great trend. Obviously, post Sarbanes-Oxley and more regulation, you saw fewer companies go public. We'd love to see that trend continue with more companies going public. And obviously, 20 and 21 were record years for IPOs. Obviously, a lot of those companies have traded down, but we think there are some phenomenal buying opportunities in the classes of 20 and 21, particularly for folks who want to do their work and have a 5 to 10 year outlook.